Let's settle one of the biggest debates in finance. Real estate or stocks? Which one is the better investment? To find out, let's look at Jack and Ethan. Both are the same age, make the exact same salary, and live in the same city. And on day one, they're both starting off with $50,000 in cash. The only difference is what they do with that first 50 grand. Jack buys a rental property. Ethan buys index funds. Both think they made the smarter choice. Both might be wrong, because one of them forgot to count something that doesn't show up on a spreadsheet, and the other forgot to account for something that barely matters in year 1, but becomes really difficult to ignore by year 20. And honestly, we've seen plenty of people spend years wondering whether they built their entire financial lives around the wrong decision. Now look, at first glance, Jack looks like the winner. He has a physical house, a tenant, and a monthly rent check. Something real to talk about with his friends and family. Ethan has a number on a screen that goes up and down. No one is impressed by an email confirming you bought an index fund. But over a 20-year horizon, we notice something consistent. The further you get from the day you invested, the less obvious it becomes which investment is better. Let's run the numbers and see who wins. Jack uses his $50,000 as a 20% down payment on a $250,000 rental property. Nothing fancy. It's not a new house, just a small 3-bedroom house in a decent neighborhood. He finances the rest with a 30-year mortgage at 6.5%. His monthly payment is about $1,600, and since it's an investment, he's finding himself a tenant. The tenant, a young family, pays $2,100 a month to rent the entire house. On paper, Jack sees about $500 left over every month. This feels pretty good. Jack owns a house, and someone else is paying down his mortgage. And the bank gave him control of a $250,000 asset using only $50,000 of his own money. Ethan takes the same $50,000 and buys a low-cost total US stock market index fund. He sets up an automatic contribution of $300 every month. And then he mostly ignores it. In the beginning, this isn't even a competition. Jack owns property, has a tenant, a mortgage, and a story to tell. Ethan has a brokerage account and an app on his phone. For the first few years, Jack feels like a genius. Rent checks show up every month. He drives past the property and thinks, I own that. People ask how the rental is going. Some of his friends wonder if he's buying another one. Even family members say they wish they had bought rentals years ago. Ethan's experience looks very different. He checks his brokerage account every once in a while. Sometimes it's up, sometimes it's down, but really, it's not moving much, and mostly, it just feels boring. After the first year, his portfolio is worth about $55,000. By year 2, about $61,000. Nobody asks him about it. Nobody invites him onto a podcast to talk about his experience buying index funds. It's just a thing that he has going on in the background. That's usually how compounding starts. Jack gets rent checks. Ethan gets quarterly statements. One feels productive, the other one is easy to forget about. By year 3, Jack has collected around $76,000 in rent. His mortgage payments were $58,000. That looks like $18,000 in profit. And honestly, this is where a lot of people stop doing the math. But in reality, it's more complex than that. Property taxes go up. Your home insurance says they have to keep up with inflation, so your premiums go up. A water heater breaks on a freezing Tuesday night. The ignition on your furnace decided to retire early. If you're an experienced investor, you know the 1% rule. You need to set aside 1% of the property's value every single year just for maintenance. In addition to maintenance, you also have vacant months, cleaning costs, new tenants. Some years are definitely easier than others. Rentals don't send you emails saying, "Congratulations, this year will be maintenance free." And then there's time. Late night calls from your tenants, contractors during work hours, Saturday showings. Jack quickly realizes he didn't just buy an investment, he signed up for a part-time job. But even then, he feels pretty good. His property has gone up in value. It's nice to have someone else pay down your mortgage. But after expenses, his cash flow is probably closer to $2,000, $3,000, maybe $4,000. Not terrible, but definitely not the story he was telling himself when he bought the property. Meanwhile, Ethan's investment strategy looks very different. Every few months, his index funds pay out a dividend. He doesn't spend it. He has it set to automatically reinvest, buying him a little more of the entire US economy every time. By year 7, his portfolio has quietly grown to $150,000. He has no middle-of-the-night tenant calls. His money is doing all the work, while Ethan is doing what Ethan does best, which is nothing. By year 10, things finally become easier to compare. Thanks to a steady 3.5% annual appreciation, Jack's property is now worth $340,000. But with a 6.5% mortgage, the monthly payments are heavily front-loaded with interest. After 10 years, Jack barely chipped away at the principal. He still owes the bank roughly $173,000, leaving him with $167,000 of equity. Most rental investors would feel pretty happy with that. On the other side, Ethan, assuming an average historical 9% market return, has watched compounding work its magic. He ignored most of the financial news, and he didn't try to pick the next Nvidia. His $50,000 start and $300 monthly habit has grown his account to just over $178,000. That's surprisingly close. It's neck and neck. Jack's use of bank leverage is powerful, but Ethan's hands-off approach has actually pushed him slightly ahead in total net worth. It's close enough that the answer to which investment is better now feels much less obvious than it did 10 years earlier. But year 10 isn't really the interesting part, because by year 20, things look different. Now, if you're personally team stocks, hit subscribe. But if you're team real estate, hit subscribe. Now by year 20, Jack's property is now worth just under $500,000. Most people would look at that asset and say, Jack is quite wealthy. But remember, he's on a 30-year loan. Even after 20 years, he still owes the bank almost $107,000. That leaves his actual real estate equity sitting around $390,000. And that is before you subtract the thousands he had to spend over 2 decades replacing the roof, updating the HVAC, and paying local taxes. 20 years is a long time. Chances are he will have at least one major renovation. And enough tenant calls to remind him that this wasn't exactly passive income. Meanwhile, Ethan spent those 20 years doing almost nothing. His original $50,000 stayed invested. He just kept adding those $300 a month. He didn't chase hot sectors, he never panicked during market crashes, and he never missed a month of investing. Because his dividends were automatically buying more shares, his portfolio is now worth over $480,000. For 20 years, Jack looked richer. Jack felt richer. But by year 20, Ethan's steady habit overtook Jack's part-time business. Jack worked for part of his wealth. Ethan mostly waited for his. Now here's the important part. Does this mean stocks are objectively better? No, it doesn't. And this is why. If you're as old as us and actually invested during the dot-com crash of 2000, you know what investors did back then. The biggest lesson our industry took away from that crash was this. In times of high risk, human brains are not wired for logic. We're wired for survival. Try to put yourself in that position for a second. The Nasdaq was down 78%. That's almost 80%. Your investment portfolio basically evaporated. It's been falling for months, and it might fall more. Your company is openly saying they will do several rounds of layoffs. Most other companies are laying people off too. If you get laid off, you probably won't find a new job for a while. You have bills to pay. You have to put food on the table for your kids. What do you do with your stocks? Many of the dot-com bubble companies that were so hyped went to zero. They went bankrupt. If you held those individual stocks, those positions just went to zero. Our brains are wired to prioritize survival in times of high risk. If you look at your portfolio now, your brain is not in survival mode now. Unless you're really wealthy, thinking you'll stay 100% rational in a situation like that, well, with high probability, not happen. Today, many people have either forgotten about this lesson because it happened too long ago, folks retired, or younger investors simply haven't gone through a time like that yet because they're too young and it hasn't happened in a while. People sell. People wait for things to feel safe again. People miss recoveries. If you panic and sell, your compounding resets to zero. Ethan may have gone through a 20-year period where we didn't have a crash like that. Good? Yes. Lucky? Yes. It took the Nasdaq 15 years and 3 months to fully recover back to its dot-com high. That's a long time in anyone's life. Does this mean real estate can't crash? Absolutely not. Housing markets crashed in the next crisis after that in 2009. This is a real risk for both Ethan and Jack. If one of the investments, stocks or real estate, goes through a crash, then it just comes down to timing. The investment that doesn't go through a major crash likely wins this competition. Are they connected? Yes. If one crashes, the other will go down too. But they're not connected one-to-one. But outside of crashes, who would have won? Both of them did, in different ways. Most people would probably be happy ending up in either position. But if there's one takeaway from all of this, it's this. Jack and Ethan didn't just choose between real estate and stocks. They chose between two very different lifestyles. And different people with different personalities do well in different environments. So the trap on your financial journey isn't choosing real estate and it isn't choosing index funds. The trap is picking a path that doesn't fit your personality. If you want to stop making expensive financial mistakes, hit subscribe. We take institutional investing frameworks and break them down into actionable decisions for your portfolio. Subscribe to build wealth like an insider.